So take us into this world of bond ETFs. A lot of us think about it in terms of stocks, but it's going to be quite a substantial part of the market.
It is, and I think it's poised to grow even more. As we talked about earlier, the global fixed income market is 120 trillion, and so 2 trillion seems like a drop in the ocean. So I think the growth is just beginning. But I think the important aspect of ETFs for bond investors is that it's changed how the market trades. And it's created more liquidity in the marketplace. And post-GFC, it's allowed to bond investors, I guess, to reliquify in ways that they didn't imagine prior to.
So why has it grown so big? And you mentioned the great financial crisis there. Is that part of the cause in the sense that there was a lot of regulations that came in after that that really made it a little harder for some of the dealers to keep big balance sheets?
That's precisely right. The dealer balance sheets were really constrained post-GFC through the alphabet soup of different kind of regulations, and it really hurt the end investor because you as a fixed income manager have to go through the dealer in order to transact. The ETF platform, I call it the chassis, the infrastructure, allows through the redeem and create process trading of individual bonds in ways that were unimaginable before. And so this revolutionary, evolutionary type of process has really allowed fixed income to reliquify and trade much better.
You mentioned one of the effects is increased liquidity. Back during the pandemic, March of 2020, we had some problems with liquidity. Do the bond ETFs hold out the possibility that they will be able to take us through some of those rough patches?
I hope so. One event doesn't, make a declarative statement, of course, but it was really interesting. Back in March of 2020, voice trading effectively shut down. And what you saw was through ETFs and electronic trading, which is still only about 45% in the entire fixed income universe, traded at levels that we haven't seen before. So we had record levels of volumes at a time when it was really difficult, almost impossible to transact elsewhere. So I think that is a testament, of course, but each crisis is a little different. You just don't know, but I think the early signs are actually quite positive.
You mentioned voice trading versus electronic trading, which is one of the advents here. As I understand it, stocks are more likely to be traded electronically rather than through voice. Why is the fixed income market behind in that? Is that just a matter of timing, or are there some inherent differences in bonds, in part because there are so many different kinds of them, but that really keep you from doing more electronic transfer with bonds?
I think it's a little bit of both. I think historically the fixed income market has been known late adopters. Also at the same time, as you mentioned, unlike a single stock, you have multiple bonds off a name. So use IBM as an example. There's only one equity security to trade, but you could have anywhere from 50 to almost 100 different CUSIPs of IBM. So it's just, the complexity is just much more difficult. And the market is much more segmented as well. So I just think it's about time, because if you think about complexity, that's where computers and machinery and algorithms can really add a lot of value. It's just been slow to adopt.
Who are the most likely customers for the ETFs? You say you think they're going to keep growing the bond ETFs, but who are the people that are target customers for it?
Yeah, so what's interesting about the bond ETF market is that if you look at, particularly relative to the equity side, it's institutional bond managers like myself and ourselves at PGIM that actually utilize that security. So it's a much more of an institutional vehicle on the fixed income side, whereas on the equity side it's much more retail driven. So we'll see how that changes over time. But the way that active money managers like ourselves think about these passive ETFs, it's a way of kind of modulating your liquidity, modulating your portfolio risk in a more seamless, efficient manner. So that's why it's taken off.
As a big manager of fixed income here at PGIM, do you tend to trade in individual bonds, or is this in whole portfolios that move at the same time?
It's both. So you tie ETFs, that infrastructure, to what you're seeing through electronic trading, namely portfolio trading, which is not a CUSIP-driven trade, it's a characteristic-driven trade. And so you now can trade, up to 100 some odd names in package form and get liquidity. Whereas before, David, you had to kind of on the phone call individual and trade lot by lot. And that was just grossly inefficient and really difficult to prosecute. So the packaging has been the key risk transfer piece to it all.
Well, we said it's gone from, what, a couple $100 million up to $2 trillion now. How big can it get? Where's the sky here that it could grow to?
That's an excellent question. I'm not sure if you talk to some of the real ETF advocates, the sky's the limit, of course. But I think there's real scope for it to grow and to continue to grow. The issue around fixed income is the fragmentation of fixed income, right? So we talked about 120 trillion globally. You have various government securities, you have corporates, you have high yield, you have levered loans, you have all these different products. You have privates as well. And so it's not homogenous, right? And so I think it makes it much more difficult to kind of finally put a number on it. But I still think growth is upon us.
You mentioned privates, which has been a big growth area in your business in private credit. Are they involved in the bond ETFs, and is there a possibility for more privates to be involved?
There is that talk, there is that race towards taking private credit, which doesn't get marked and has no liquidity, into an ETF. Quite frankly, I'm not sure how that will work, but some institutions are desperately trying to put that forward. So it'll be really interesting to watch. But the interesting aspect about how ETFs are being used is somewhat kind of alchemy in a way, right? So you take illiquid or less liquid securities and package it and turn it into a more liquid product. So the question on the table ultimately, David, is will taking a package of private loans or bonds with virtually no liquidity and turn it into a vehicle that has some liquidity? We'll see how that plays out.
In life, at least I like to say, there's no such thing as a free lunch. So this is more liquidity, new innovation, more electronics. What are the risks in this growth in bond ETFs as you see it? Are there risks out there we should be at least thinking about?
I think there's always risks. I think the one risk that I think about is, do you have such an over-reliance upon this one aspect? So if you think about kind of the ETF infrastructure and the create-redeem process, it's a handful of names that's determined by the provider. And so does that cannibalize other parts of the marketplace over time? And if that shuts down, does that have an amplifying, cascading effect across the system? So the truth of the matter is we don't know. It hasn't been tested. We haven't had a credit cycle in a very long time. So there's still a lot of tests that we need to kind of go through. So we shall see.